What's up, y'all, and welcome. Okay, so today we're going to be talking about a pretty important topic: market crashes and the Fed's cutting interest rates to 0%. I'm going to talk about this in 4 steps. First, I'm going to talk about why the stock market is crashing. Number two, I'm going to talk about the Fed's emergency rate cut to 0% and announcing quantitative easing. Four, what does all that mean? Number three, I'm going to talk about how all of this affects you and I, the average person. And number four is I'm going to be talking about my final thoughts on all of this. But before I get into all of this, shout out to my returning subscribers. Thank you guys so much for the support. I really appreciate it. For those who are new to the channel, my name is Faithful Lobby. I post videos every week on topics related to money, mindset, and business. If you want to learn something new in these areas, feel free to subscribe down below, hit the like button. Okay, let's get into it. I want to dive straight into this topic. Okay, number one, why is the stock market crashing? Okay, so far we've seen the biggest single-digit percentage drop since Black Monday in 1987. This is crucial, y'all. We're currently witnessing history. The first reason why I think the stock market is crashing is oil prices had the biggest single-day crash in history, crashing 30% in prices. This is crucial. We're witnessing history again. But the reason that this crash occurred was between OPEC, Russia, and Saudi. And what happened is Russia pretty much rejected a proposal from OPEC to reduce their oil production because the United States put a sanction on one of Russia's biggest oil producers because the oil producer was still transporting Venezuelan oil, and the United States did not like that, and they put a sanction on Russia, and Russia said pretty much a middle finger to to the United States on when they offered the proposal, and Saudi responded by flooding the market with oil. They pretty much cut the prices per barrel that they create, and they also increased the production of oil, which increased the supply, decreased the prices, and decreased the demand. Number two is, as we all know, the global pandemic that's currently going on. Unless you live under a rock, you know what's going on right now. So what this is causing is affecting a lot of things right now in the economy globally. And as you can see, universities are shutting down here in the United States and shifting online. Schools are shutting down. Airlines are getting affected. Cruise lines are getting affected. There's a lot of uncertainties right now, which is decreasing the productivity overall for people in the economy. People are working from home. People can't work. Companies are shutting down. Restaurants are shutting down. This is very important for us to keep in mind. And the biggest thing this leads to is uncertainty. Being that the consumer spending drives the economy, and this uncertainty is causing a lot of consumer confidence to decrease. This makes it really hard for people to really have confidence in the economy because they're uncertain on the future. And also investors' confidence is also decreasing because they are losing confidence in the United States economy also. These are the two biggest factors that is currently sending the stock market into crazy numbers, and we're witnessing history. Okay, number two, the Fed's cut rates to 0% in quantitative easing for all. So first, who are the Feds? I want to make sure everybody is on the same page. The Feds are the Federal Reserve banking system. They're the central bank of the United States. And what they do and their main function essentially is to control the price of money. And they do this in various amount of ways by creating new money, printing money, and controlling interest rates, which is the federal funds rate, which leads me to my next one. What is the federal funds rate? The federal funds rate is a short-term lending system between the central bank and commercial banks like everyday banks like Wells Fargo. And this rate is tied to your mortgage rates, car loan rates, student loan rates, and different rates in the economy because it's the Fed's rate and it's essentially the control of the price of money. Now, the next part I want to talk about is no reserve requirements that the Feds implemented when they announced everything that they're doing. So what a reserve requirement was that usually banks, like your everyday commercial banks like Wells Fargo, had to have a certain amount of money with the central bank, the Feds, in order for them to lend money into the economy. And what the Feds essentially did was they said there's no more requirements for that. Any bank now can lend into the economy. So no bank now has to have a certain amount of money with the Feds in order for them to lend into the economy. Now, next one is, what is quantitative easing? It sounds like such a big word. I remember the first time I heard it, I was like, what is this? But it's just a fancy word for money printing. And the Federal Reserve does quantitative easing to stimulate lending in the economy and investments, which means now money becomes cheaper and people are willing to now go out and go borrow more money and invest their money to stimulate the economy. And this is all done through pixels on the screen. It's all digital now. Previously, back in the day, they used to literally print money, but now it's just all digital. And the way this works, to give a really quick example and some visual. So let's say you had a commercial bank like Wells Fargo. Now, usually Wells Fargo, the way this works with quantitative easing, Wells Fargo would go buy treasury bonds, pretty much the government's debt, the government's spending, and they would buy mortgage-backed securities and all these assets, buy that from the government, and then take that and go sell it to the Federal Reserves. And what the Federal Reserve then do is then give them money in order for that transaction. And what Wells Fargo will do is they'll take that money and then go lend in the economy. That's how it's supposed to work. But it doesn't always go that way. Okay, now what is quantitative easing for? So quantitative easing 1, 2, and 3 was done throughout 2008 and during the great financial crisis, the housing bubble crash. And when it was done over the course of $700 billion over the course of those years, in order for them to purchase all those bad assets, which were mortgage-backed securities and all these things that were occurring in the economy that caused the bubble to pop in the housing market. Now, with quantitative easing 4, they've just announced they're already offering $700 billion. Now, $500 billion of this $700 billion is going to be towards treasury bonds, pretty much the government's debt spending. And $200 billion of that is going to be towards mortgage-backed securities. So in order to make people go buy houses and things like that. One thing I want y'all to keep in mind also is interest rates and prices have inverse relationships. So when interest rates normally go down, prices normally go up. Okay, number 3, how does all of this affect us, the everyday person like you and I? First of all is lower mortgage rates. So right now would be a really good time if you have mortgages that have high interest rates to refinance some of those rates. Number 2 is lower rates on savings account. Okay, for those who have high interest savings accounts, I know y'all got the email, rates have been cut. Yes, and I know this is a very tough one for me, because my rates have been cut, and it's very hurtful because they're trying to force us to take our money out of savings to spend it and stimulate the economy. Now, number 3 is lower student loan rates. Now, this is important because if you have a variable loan rate, you potentially be able to see your rates go down. And if you have high interest student loan debts, this is a really good time to refinance some of those rates to make sure you can save money and get money cheaper. Number 4 is lower auto loan rates. So buying cars, refinancing your car loans if they're really high, it's a really good time right now. And number 5 is lower credit card rates. Now, average credit card rates is about 20%, but being that credit card are one of the biggest money makers for commercial banks like Wells Fargo and Bank of America, I don't see this really getting any lower, which should be it's really a scam. It should be about the rate of what the federal funds rate is, but yeah. Number 4, my final thoughts on all of this. Okay, so the first one we all have to keep in mind is inflation, hyperinflation, and stagflation. Now, being that the supply of money is being created by the Federal Reserve Bank, the Feds have already committed $3.3 trillion currently in something called the repo market. So what the repo market is the repurchase market. It is the engine that keeps the economy going. It's a behind the scenes trading between banks, hedge funds, and money market accounts. And one thing we have to keep in mind is when the Feds create new money, we have a really high chance of inflation. When supply is drastically increased into the market, supply of anything, it really increases the price. And hyperinflation is something we also have to keep in mind, because hyperinflation is when pretty much the dollar is worthless. Stagflation is something we could see, like for example in Japan, where we don't see a growth in the economy for the next 30 years. And you're probably asking, Why haven't we seen any of this? The feds have been creating so much money before. Well, this leads me to my next point. All the oil transactions is denominated in dollar. So what this means is globally, whenever countries trade oil, they have to use the dollar. And they have to use the dollar because the United States dollar is the global reserve currency, meaning that the dollar is the foundation that people bank on whenever they're making transactions globally. And this is called the petrodollar. I'll throw a definition up here. But essentially, we have those things outside of the United States that is keeping the dollar in demand with all this money creation that we're also doing. We can't just think just in the United States. We have to think also internationally how the dollar is affecting other countries and how it could potentially affect us also. Because when we lose those two status of being the global reserve currency and also all transactions of oil being denominated in dollars, that's when we have a real problem, in my opinion, a very serious problem, because that means demand for the dollar outside of the United States is completely gone. And as you know, we're having problems right now with Russian oil. Yeah. Okay. Next is number 3 is, in my opinion, we in an everything bubble. Oh my goodness. And I could do a whole video on this, a whole documentary and all this, but it's gonna take way too long and I really want to make this video short. But I mean, we have the pension crisis, corporate bond bubble. Oh my goodness, guys, I think my throat might be coming down with something. Okay, now I'm gonna cut the video short there. With that being said, I really appreciate you guys. Thank you so much. If you made it this far, you're a real one. Thank you for sticking with me all the way to the end. Please feel free to hit the subscribe button, the like button, share this video with your friend if you learned something new. The more we know, the better it is for all of us. Thank you guys, and I'm out.